Well, good morning or good evening or wherever you are in the world. Welcome to the Startup Builder live Q&A. I'm your host today, Kirk Drage, the CEO and co-founder at Leapsheep. This is where startup founders come to ask questions that are keeping them up at night and learn from people who've actually built the systems that work in the real world. At Leapsheep, our mission is really simple: to materially improve founder success rates by helping you build clarity and systems before the chaos sets in. If you're joining us live on LinkedIn or YouTube, drop us a comment to tell us where you're coming in from. If you've got questions, drop them in there too. We'd love to interact with you during the show. We'll be pulling questions directly from the chat throughout the session, so do drop those in. Whether you're just getting started, whether you're building your early traction, or you're starting to converge on product market fit, this is the place for you. Today's session is all about financial clarity, not accounting for accounting's sake or bookkeeping for bookkeeping's sake, all super important, but about financial clarity for your startup, about systems that can help you make decisions. I'm joined today by Cornell Tsiang from Fractional CFO and founder of Adeptx. Cornell has led finance at companies like Amazon and Groupon, helped deliver over 500 million in revenue across APAC, and now works hands-on with B2B SaaS founders who want clarity on runway, burn, growth without slowing their execution. Cornell works with founders who often feel like they're growing but don't fully trust their numbers, feel like finance is reactive rather than proactively helpful, and every growth push creates more complexity. Cornell, welcome. It's fabulous to have you with us.
Pleasure, Kirk.
Well, it's great to have you on. I know finance is such an important area of every startup, and it's often a journey that you need to learn as you're flying the plane. You need to build it, as they say, for many founders that don't come from a finance background. So I'm really excited to dig into today's conversation because you've got some phenomenal experience. Let's maybe start off with a bit. Tell us a little bit about your journey, things like working as a lead for finance for Amazon in Beijing, for example.
Oh, okay. So yeah, for a long time, I've been in finance for a long time, and started off as an auditor, and then I became an investment banker. Started off in Melbourne, and then I moved to Asia, and I was in Hong Kong for a while, and it was a sort of strange opportunity I got because I'd always wondered, as an investment banker, most of my life is spent talking to CFOs. They're my client across the table, and I always wondered, what did they actually do? Because I had no idea. No, I didn't. I just sort of aside from me telling them, aside from me telling them, I want you to do this for me, I want you to do that for me, and then they'd run off and do something. I was just like, actually, what did they actually do? And I got an opportunity to run a startup in Beijing, and I was getting pretty tired of investment banking. So I started doing that. And then I got the opportunity to work for Amazon. A friend said to me, "Oh, look, Amazon has bought a business in Beijing. They're looking for a CFO. Do you want to apply?" And I said, "Sure." And I didn't think much of it, but yeah, it's not easy. It took 15 interviews before I got the job. Yeah,
I had a similar experience. That many interviews.
Yeah. They put you through the ringer. I just sort of had a couple of interviews when I was in Beijing. They flew me to Seattle, and then I spent 14 hours with and just 12 interviews straight, one after the other, bang, 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 bang. And everyone from FP&A to the treasurer, to the group CFO, to the head of international, to a financial controller, and they just grilled you non-stop.
Yeah.
But I can understand why, because at that point in time, Amazon's an interesting animal in terms of, at least in my part of the Amazon, which is finance, in that they rarely fire people. They don't like to fire people.
Well, the companies are growing so fast at that stage, aren't they? That usually people are moving into new roles all the time, and they can't hire fast enough generally.
Yeah, but Amazon had a pretty mature attitude. They had about 12,000 employees by then, or 18,000. But their attitude was, at least from what I could see, was that they didn't like to fire people. So in order not to fire people, they had to absolutely make sure they were hiring the right person. And that's why they ran you through the gauntlet, because they wanted to 100% make sure you're the right hire. And the thing is, at Amazon, one of the values they have when they're hiring people is that they get all the stakeholders in the room, and everyone has to agree. Everyone has to approve the hire. And if you don't approve the hire, you have to put your hand up and say why you're objecting. And if your objection is valid, you're gone.
Yeah.
That's it.
Yeah, because hiring the wrong person, it's so expensive. And I understand why they've got that place. It does work well.
Yeah.
We have
Amazon. Amazon was an amazing experience. It was it really taught me what it was to be a CFO, and two key skills I learned from that. Number one was strategic planning, because I had never learned strategic planning before. And number two, strangely enough, it was team management, how to manage a team. Because I had 35 staff, and I'd never managed such a big team before. And an investment banker, you sort of your team constantly changes, because you move from one deal to the next deal, and each deal had a different team. And then when I was at Amazon, I suddenly realized, oh, this is my team. They're not going to change. I have to manage them. Huh?
I better play nicely in the sandpit.
Yeah, exactly. I actually have to manage it. So, and the key lesson I learned, the most valuable lesson I learned in team management, was that the more effort you put up front in teaching and training someone, so you put in 10% up front, you'll get 110% at the back end from that team player. It's really incredible. I mean, it's just some of the things that my analysts, at the very beginning, they could barely do a spreadsheet. And then we taught them, and in 12 months, they had insights that really, it just astounded me and astounded the FP&A director. Like, how did you figure that out? And they just worked it out. It was amazing.
Yeah, I mean, it's so fun in those kind of corporate settings where you've got you've got the intellect, and you've got the capability, and you've got the infrastructure around you, and you've got the luxury of time, which are a lot of things that you don't have in the startup world.
Indeed.
Let's maybe pivot to the startup world, because as much as I love talking about the corporate space, and it's such fabulous experience to have behind you before you move into the startup space. The startups world's obviously very different. When you started working with early stage companies, what were the things that you started to notice about finance for early stage companies, and how to build finance systems from scratch, and how founders need to think about financial clarity for their businesses?
Yeah, it's a good question. It kind of depends on the size of the startup, ranging from, you've got several different layers you need to think about, because as you go through each different layer, your level of financial capability and your level of financial sophistication alters quite a lot. So if, for example, the typical clients I deal with are around the $3 to $5 million ARR level. So they've gotten to a level of complexity where they need a fractional CFO, and they need to upgrade their finance stack, and they need to be able to get clarity on their performance, and as well as future growth. But what they need, compared to someone who is, say, for example, struggling with product market fit, right? They're at the early stage, is completely different. So like I said, so if I was to go on that journey, on that curve, I'll say at the very beginning, if you're at a stage where you're developing a product, right? You're pre-revenue. Say you're pre-revenue. If you're pre-revenue and you're developing the product, the focus from a finance viewpoint is going to be fairly basic. It's going to be driven by compliance, because you've got to pay your taxes, or you've got to fill in your tax returns, and you've got to make sure that you're paying your employees properly. So it's going to be very compliance driven. It's going to be very cost driven, and then you're going to be doing things like your R&D tax incentives. So you're going to be doing your grants. You're going to be applying for your grants perpetually, which is very painful.
Yeah.
You need to do it.
Just to sum up what you're saying there, you're going to be expense management focused.
Yes.
And part of that is to make decisions about, how long you can go for with what type of team, what composition of team, and how long can you go for. That's a big part of what you're doing, isn't it? It's about managing your, the terms that we use are a runway. How long have you got? And your cash burn on a monthly basis. So it's a very cash flow view of finance, isn't it? And it's around decision making around what kind of resources can I keep together for what period of time to get some of the early traction I need to get more resources in, whether that's you're going to get resources through revenue from customers, or you're getting finance from other sources like investors or grants or what have you.
Yeah, no, that's absolutely correct, Kirk. That's actually how I should have framed it. It's very cash flow orientated. And actually, I was speaking to a cybersecurity founder. He's been running his business for, I think, 10 or 11 years now. So he's gradually becoming more successful. And he had an interesting analogy when talking about your resources. And he said, the more resources you have, the more risks you can take. The less resources you have, the less risks you can take. So you have to be very, very careful about your capital and how to allocate it. And so if you look at it in terms of your burn, it really is about how to extend your runway as long as possible. And then alluding to the point you made is the decision making you go about how to allocate what capital or funds you have. You have to be very careful about that. If you're not getting revenue, and if you're not getting angel investing, when you're not, and there's the delay in getting your tax incentive, etc. The basic tool I have, which I think any startup should have, it doesn't really matter what stage of maturity you are. If you're pre-revenue, or you're struggling product fit, or you're scaling, or you're at 20 million, or you're at 50 million, or you're at 100 million ARR, the most basic tool that you need to have from the very beginning is a 13-week cash flow forecast. Absolutely mandatory. Absolutely mandatory. You talk to any CFO, I guarantee, and ask them what are their top priorities when they join a company. I guarantee you, one of the top 3 answers they'll give you, managing cash flows. It doesn't matter what the business is. It could be manufacturing air conditioners. It could be primary resource and coal and gas, or whatever. Any CFO will tell you one of the top 3 answers they'll give you when they join a company. The first thing they do is they look at the cash flow. Yeah.
And you said 13-week. That's just a quarterly cash flow.
Yeah. So it's a 13. What I call it is a rolling 13-week cash flow forecast. So 13 weeks is basically a quarter. Every time you finish a week, that week drops off, and then you add a week. So it just keeps rolling and rolling and rolling.
Yeah, that's a great.
It's pretty straightforward to do. I mean, particularly if you're at early stage, because you're not going to have much revenue, to be honest. So you're going to be managing. All you need to do is you just map out your 13 weeks, week 1 to week 13, like this week ending 8th of February or whatever it is. and you put in your payroll. You pay your payroll every 2 weeks, so you know what that is. You pay your BAS every month or every quarter. You pay your super, and then you put in all your subscription costs or your AWS costs. When is the bill due? When do you actually pay? And you just list it out, and you just map this for 13 weeks. Yeah. So you kind of, by doing that, you'll then know what your burn rate is, number one. And number two, you don't get any surprises, which is really critical, right?
Yeah. And that really plays into the agile, lean mindset, which founders, are best to adopt, because it's that cycle, and it's constantly replanning. So you're saying every week you're basically just pushing your perspective out another week and another week. So you've always got that 3-month horizon that you can make better decisions in, because you've got that 3-month visibility.
Yes, that's right. Like I said, so it gets rid of surprises. You kind of know what's coming ahead. Because sometimes if you look at a spreadsheet, say you do a 12-month forecast, right? And you say, oh, okay, I've got this subscription that cost me, say let's cost you $1,000 a year. And you sort of amortize it over 12 months. But you forget the fact that actually you've got to pay that $1,000 upfront.
Yeah.
It's due next week. Oh, right. Whoops. I forgot about that. So the 13 week was that, no. I know this invoice is coming in on that date, and I've got to pay by that date.
Yeah.
So it's very granular and very, very straightforward.
Yeah. Really good. And have you had any experience with helping companies put that in place, or any war stories from people that haven't had that in place that would be valuable to share?
I usually put it in place for most of my clients, but admittedly, by the time they're at the $3 to $5 million stage, they've got a pretty good grip on cash flows.
Yeah. But what about for businesses? Would you use a tool like Excel? What's your sort of go-to tool to keep it simple at that very early stage?
Excel. I mean, just not Google Sheets. I hate Google Sheets. It's horrible. But just Excel. And this is the dark secret of a financial planning FP&A analysts is, despite all the fanfare hoo-ha about all these fancy spreadsheets, etc., the vast majority of financial experts use Excel. I mean, like, when I say the vast majority, I'm saying like 60% of experts still use Excel as their core tool. I mean, they may have NetSuite, they may have Oracle, they may have all the fancy FP&A tools, and I use them as well. But at the end of the day, if you say, okay, hey, tell me about that retention, tell me about the, what's the expansion metrics for that cohort?
Yeah.
And watch that expert jump to an Excel spreadsheet and say, here it is.
Yeah, and I think AI is just cementing that model in place, isn't it? Because now you can do so much with AI and Excel.
Yeah, that's true. I've always got Copilot sort of bugging me in Excel. I can do this for you. I can do that for you. Okay.
Yeah, it's pretty impressive what Copilot can do with Excel, a bit of Python and some AI. I mean, this is such a valuable conversation. I think that it's a great piece of real practical advice, is to get that quarterly rolling cash flow view in a business. So if you're listening to this and you've got any questions or stories to share around that, advice for other founders that may not be where you are, please drop that into the chat. Moving on from that, when you start to get a little bit of revenue in the door, what tends to happen next?
Yeah, so when you start getting revenue in the door, I mean, essentially what that means is that you're starting to win clients, right? So when you're starting to win clients, everyone gets very excited about it. and you're starting to, it's sort of proof, or you're getting proof that your product there's market demand for your product, whatever your product is. I think for me, it's still when you're at early stage, there's still, for me, it's still, there's not that much you need to do in terms from finance, because the thing for me is, we always how we make fun of the hockey stick, right? The hockey stick curve, right? And it's like this smooth transition. And then people do this sort of realistic thing where actually it's sort of like, it's like a roller coaster. It's up and down.
Yeah.
Down. And I think you need to be aware of that when you're starting to get revenue, is to have that mindset of it'll come in, growth will be in spurts. My experience that growth comes in spurts. It's sort of, you'll have this period where you will start accumulating some clients, and then there'll be some periods where it goes completely flat, and then you'll get another spurt, and then it'll go flat again. And so you sort of, but when you're in the moment, it's sort of, you kind of thinking, oh, it's feast or famine, and then you're bouncing between despair and elation, right? That's your emotions are sort of like bouncing between the two. But what you need to do eventually is that after 12 months, you look back and you suddenly realize, oh, well, okay, yeah, so we've had these ups and downs, but the curve, even though it's going up and down, is still going upwards, right? It still has that trajectory. It's just very volatile.
It's just lumpy. If you smooth it out, it's up and to the right, but it's not smooth.
No, it's not smooth and right. And I think for me, it's a case of, I would look at early revenue as just not so much as something to survive on, but just as proof points of market demand for your product, but initial proof points. One of the things that I also noticed, I noticed this actually strangely enough at Groupon, was that you also have to examine who is buying your service or who is buying your product. You have to examine them really, really closely. And my recommendation is to really grill those early stage customers as much as you possibly can. I mean, give them as much customer support as you possibly can, but at the same time, grill them, because
in a
friendly manner. But because for me, the pitfall is these folks may be early adopters. They may not actually be your ICP. And that's what you have to be very wary of, because early adopters have very large tolerance for mistakes. They have a large tolerance for mistakes, they have a large tolerance for things that don't work, because they're early adopters. But they'll churn quickly too, because they'll play with it, they'll get bored, and they'll drop you.
Yeah, I want to slow down, because I think this advice is one of the most important pieces of advice or perspective that you can give an early stage founder, and I just don't hear it enough. I don't hear advisors, people talking to startups in the startup ecosystem, explaining exactly what you've just explained. And what the alternative, what I do see a lot of, is a lot of charts that go up and to the right in a very linear kind of fashion that are what, for example, a government grant or some early stage angel investment is predicated on. And then when the reality happens and the lumpy revenue comes in fits and starts, as you've just described, people begin to worry. But as you've described, this is really natural. It's, the chances of you getting your product perfect out of the gate, where you know exactly what an ideal customer looks like and exactly what the ideal customer experience looks like, is almost zero. It's not zero, but it's almost zero. And so, as you're saying, those first customers are just learning opportunities for you, and you're going to have customers in that first batch, as you say, that are not really your ICP. They're people that are willing to give you a go. They're curious. They're not buying the product for the reasons that you think they're buying the product. And so you learn that kind of customer is not the best kind of customer for you. And that's a great thing. That's real progress in your startup. That learning is real material, solid progress. And if you're just measuring success by revenue, then you don't necessarily see it as progress. So that is just such important advice. I just can't emphasize enough how great that advice is. And I think just sitting founders down and telling them that would reduce anxiety levels across the founder ecosystem massively, because I think we all expect our revenue to go endlessly up and to the right once we've got something out of the gate, right?
Yeah, no, absolutely. I was talking to another founder. I had a chat with him about a year ago, and he's been running his business for 6 years. Yeah, 6 years, I'd say. And he honestly said, for the first 4 or 5 years, so for a long time, he was not convinced he had product market fit. He just wasn't convinced. I mean, he was getting revenue, he was winning customers, but he was looking at their usage of the features, and he was looking at the behavior, the customer behavior. And whilst he obviously pivoted because there's certain features that customers liked and certain features that they didn't like, he just felt uncomfortable that it wasn't achieving. I mean, the customer were using it for the core purpose he wanted them to use a product for. And so he had to really think carefully about his product and the core features of it. And he said eventually he did alter his core features. And then he became much more secure. And then he realized, yes, these are the core features. He had to tweak them a bit and he had to get rid of some. But these were the core features that these cohort really wanted. And he got comfortable and he said, now, and then he could start scaling. He started to really see traction and scaling. And it's okay. One, he pivoted a little bit on his product, but two, he also pivoted his marketing so that he changed his ICP. And when he got, because it's kind of like this game where you're trying to match, right? You're trying to match these two things. And so it's not just one-sided. Sorry,
there's a bit of lag there. People often forget that to tweak what you have to reach product market fit, it's not only about tweaking the product, but as you say, it's also about tweaking your definition of the market. Because you may not have to change your product as much if you just change, who you're targeting it at.
Yeah, that's right. And so it took him a long time, but he said now he's comfortable and he's gotten the traction. And he knows his customers far better now.
Yeah. And that takes time to do, what you've just described takes time to, and capacity from your team to stop and, as you say, go and interrogate your customers. That's time that you're taking away from marketing to new customers. It's time you're taking away from building your product. But it's really, really valuable investment to understand. Quite often when you speak to an investor for the first time, if you're a founder, you're speaking to investors for the first time and you say, give me some advice. Investors will often say, or a successful founder will often say, things take twice the amount of time that you think they'll take, which is actually really solid advice. But it doesn't answer the why do things take twice as long as you think they'll take. And I think what you're getting to is some of the reasons why things take longer than you think they'll take, because you actually have to stop and do this work that you've just described before you can then double down on your marketing or double down on your product roadmap and then move again. Even once you move again, you have to repeat that exercise because the learning is probably not done in one iteration. It's probably going to take several.
Yeah, no, absolutely. So,
I think that's great insight. It really is.
I've just, like I said, I've seen it happening. And when I was at Groupon, actually, the funny thing was what I realized, because I was looking after 12 countries, and I suddenly realized that I was looking at this one particular metric, which was the redemption rates of the Groupon, the tickets, right?
Mm-hmm. Yep.
And I saw that the redemption rates were declining. And I mean, there's still people are still buying lots and lots, right? So the top line was looking great. You know, people were really enthusiastic, and they were what seemed enthusiastic, and they were buying. But redeeming the vouchers was declining.
Yeah.
And so that was when I suddenly realized, oh, are we hitting the right customers? Or have we got the right product mix? Are we making the right offers? Because if the redemption rates are declining, that's really that's a red flag for the viability of the business. So it's all these little metrics that made me real. That was a lesson in teaching me about sort of getting the right customer, so getting the right mix. And from a SaaS point of view, the analogy is getting the right. It's getting the right product market fit. It's this balance between your side and getting your product right, and then addressing the ICP side as well.
Yeah, 100%. Such good advice. Such good advice. So getting back to our journey for founders as they're starting to get revenue, how do they know when they're starting to get their systems right? What should they be looking for when they start getting revenue, and to help them with this analysis that you're talking about? Because finances, you want to turn finance into a decision support tool to help you look forward, not a rearview mirror, don't you? Can you just talk a little bit about that and the mindset that you would advocate founders take?
Yeah. Okay. So the first thing you can do is this is a very granular, basic thing to do at the very beginning, is when you talk to your accountant, and your accountant is probably making you use Xero or QuickBooks or whatever. Let's say they use Xero, because in Australia, most startups use Xero. And what happens is that the accountant will every month spit out your financial statements, and it'll be very generic: sales, electricity, utilities, salaries, whatever. But what the accountant is doing is that he's using what's called a chart of accounts. So the chart of accounts is basically all the line items in your P&L, all the line items in your balance sheet. And like I said, if you don't instruct the accountant, he'll just use a generic one, which you can use for any business, but doesn't give you insight into what you're doing. So what I'll recommend if any startup founder is that when they hire an accountant, if they're not using in-house, finds an accountant who knows what a SaaS is, who understands the business model of a SaaS, and then being able to do things like taking your sales and being able to split up between recurring and non-recurring revenue. This is just for an example of SaaS. So for fintech, it would be different. For e-commerce, it would be different. But just using SaaS as an example, just asking him, okay, don't bucket everything into one line item because good revenue. Yeah. Split it out between subscriptions, split it out between onboarding, integration, consulting, and then if you've got other bits and pieces, to be able to get your revenue streams nice and clear. Yeah. As well, trying to get your expenses nice and clear in terms of what's the cost of delivering your product. So, which is your cost of sales. So that would be your hosting.
If you've got different subscription levels, break them out.
Yeah, if you've got different subscription levels, break it out. Say you've got tiers: gold, silver, bronze. So if you're able to break out your tiers, the gold, silver, bronze, at the end of the day, what you want to be able to do is then be able to look at your monthly P&L and know exactly which parts of the business are doing, which parts of your product is selling well and which aren't. So that's on that side. On the accounting side, on the FP&A side, it's if you're at early stage, you then start trying to do forecasts of what things look like from your early revenue stage. but I wouldn't go out beyond 3 months. Just do a 3-month forecast, because, like I said, it'll be volatile and it won't be straight line. But you can start building out general idea, because if you've got for a SaaS, because it's recurring revenue, so you can start sort of building out, okay, this is what my revenue lines are going to look like. And you kind of already know what your expenses are going to look like, especially if you've done your 13-week cash flow forecast. Yeah. So you'll know what your expenses look like. But I wouldn't go out beyond quarterly forecasting, because you're still early days.
Yeah.
In terms of metrics, really, my honest opinion is that you're too early to worry about any advanced metrics. So, I mean, you've got your burn. You want to know your burn multiple, so how efficient you are. And you're probably going to focus more on capital efficiency than anything else. So in other words, for every dollar I invest, how much ARR am I generating? I mean, that would probably be it. So, I wouldn't be focusing on, your retention metrics like NRR or GRR. I wouldn't be looking at churn, because you've only got a handful of customers. So, any churn is like a catastrophe. So you'll know it.
Yeah.
So
financially.
Yeah. So I really, I would just stick to really 2 or 3 really basic metrics, but predominantly you still be focusing on your cash flow.
Yeah. One thing I want to make clear, because we help a lot of founders that are sort of in this transition from no revenue to first revenue to what I describe as predictable revenue, and that's sort of the 3 stages that I think about. Because in that in between stage where you're getting revenue but it's really lumpy and it's really unpredictable, like you might get some revenue coming in 1 month, particularly for B2B SaaS founders where the deal size is a bit larger. Maybe it's a $2, $3, $4, $5, $10,000 ARR kind of product. The deals can, like, 1 month you can get a deal, and then a month will go by where you don't get a deal, and then you might get 2 deals in, and another month you'll get no deals. And so you've got this really lumpy revenue, as you've described. That's when it doesn't make a lot of sense, I think, and this is a question, I guess, to look at things like capital efficiency. It's still too early at that stage, isn't it? You're really still in the view of, you're looking for managing runway at that point. You're looking at your expenses, and if you are able to get more capital in the business, spending that revenue or spending that cash twice as fast, like doubling your expenses, doesn't mean you're going to go twice as fast, does it?
Yeah, no, that's a fair point. When you're at early lumpy stage, your goal is survival.
Yeah.
More than anything else. I mean, it really is. So it really is about managing your resources and trying to understand, okay, what sort of risks can I take?
So what would you say to a founder who says that the investors are telling them to spend faster? Is that something we hear quite a bit? Is, the investor says, we've given you all this money, we want you to hire more people and buy more ads and spend faster. What would you say to that founder that's grappling with that advice?
I would say, are you going to do my next round of funding? If you guarantee me your next round of funding, I'm happy to spend more money. That's the way I put it, because I was with a startup which received a large amount of VC money, and they were given that sort of advice: go and spend, and they did. And when I joined, I had seen their financials beforehand, but they had given me their beautified financials. And then when I actually dug into the actual numbers, I realized, even though they had received the funding in January, and it was more than $10 million. So it's not a small amount of funding. Even though they received the funding in January, I could see by December they were going to run out of money because they were burning so fast. And I mean, they were focusing a lot of their capital on building the product, which was okay, but it was still the spend was so fast, and they weren't getting traction in the revenue, and whatever traction they were getting was just insufficient to cover the burn. I joined and I just said, look, in 6 months' time, we've got to do a raise. I mean, we have to do a raise in 6 months, otherwise we're toast. And they said, well, we just did a raise. I said, yeah, I know, but the way you're burning, we have to, unless we do something radically to cut the costs, we have to do another raise. I mean, getting back to your question though, if I was a founder and I received advice from the investor saying, oh, look, you need to spend more, I'd get the founder to sit down with the investor and say, give them more detail. This is the product we're building. This is the traction we're getting. This is the runway we have. We don't know when we're going to get in the next round. And this is the trajectory. So these are the milestones we're going to hit with our product. So,
yeah,
if I spend faster, I'm not necessarily going to get customers rushing to my door faster.
That's such good advice. I think about startups in sort of phases where the first stage is sort of your hypothesis and build phase. You're trying to do a bit of market demand, validation, customer discovery, got to build your product, get your first customers, get your first revenue. And then you really enter an experimentation phase where you've got to start to experiment with who are the right customers, what are the right product. This is where the revenue's lumpy that we've just described. And that is going to cost, runway, it's going to cost time, it's going to cost capital. And hopefully through that phase, and you don't know how long that phase is going to take. It could take, 3 months, it could take 6 months, it could take a year to get through that phase before you then start to converge on product market fit where you go, I'm really sure that I've got the right customers here with the right problem that's we like the term pants on fire problem. And I really know what the experience has to be. And now we just have to invest in bringing those things to reality, and chase with some more confidence product market fit. And that's where, as you mentioned, that revenue is lumpy, but it generally trends up and to the right. But during that experimentation phase, the revenue, even though it's lumpy, may not actually trend up and to the right. It may actually go down for a while and then go up and then go down, because you really are experimenting with who are the right customers, what are the right problem, what's the right product experience. And it's that middle phase that I think catches most founders and most investors out. They don't plan for that experimentation phase before they hit that pre-product market fit convergence phase. Is that match with your experience?
I think the biggest problem, or the biggest trap, I see from a finance perspective, and I've personally experienced it quite a few times, is you get this momentum, you get some initial momentum in your revenue, and I don't know, I think it's a feature of a human being, is that you start projecting into the future based on your, what you're currently experiencing. And the trap I find is that people start anticipating future demand.
Yeah.
When they start anticipating future demand, they start anticipating, oh, I will need these resources. I will need these resources, either human resource, or I'll need new software, or I'll need new systems, or whatever. And so they start investing ahead of themselves.
Yeah.
But that future, you've done the projections in your head, but it may not eventuate. And so what you're doing is that you're sinking in costs. I mean, there's that old adage, well, I don't know if it's an old adage, but it's an adage that I hear about. And that is, grow fast, hire slow. And I think that's absolutely true. You grow, you try to maximize your growth, and you wait until your team is absolutely busting at the seams before you decide to hire, because you don't hire ahead of time. I mean, that's such a mistake.
You're describing what I would say as being demand-driven. So based on the demand that you're experiencing, you respond to that demand. Don't be capacity-driven, or supply-driven, which just creates supply ahead of that demand. That's how I would describe what you're saying. Which again, it's such good advice. I'm really enjoying this discussion, because I think some of the things that you're helping point us towards is just such good fundamental advice that's going to serve founders so well.
Oh, I hope so.
I'm conscious of the time. I'd love to hear from you. Anything else that you think that we should share with founders from your experience that are in this pre-product market fit? Think less than $1 million in ARR. They're on that journey. They're somewhere in that phase. What haven't we talked about that you think we should touch on?
I think for me, if you're less than 1 million ARR, in terms of finance, I wouldn't get caught up in buying the latest system or the latest tool, etc. I would just stick to the fundamentals, and that is things like hiring the right accountant who understands your business model and understands how your financial reports should look like for you. That's number one. Number two is really cash flow management is imperative. So cash flow management is, you've got to get down to the nitty-gritty of it, and that is looking at things like, when does the cash come in? So, you may have sent an invoice to a customer, but when do they actually pay? You have to start tracking your customer behavior. And then you've got to kind of look at your bills, and when you pay your bills, and how you can maximize the amount of credit you can get from your vendors. And then looking at ways to get income coming in aside from your product, which is your tax incentives and all the other grants that you need to apply for. Doing your 13-week cash flow forecast. It's a recurring theme, because it's probably the most valuable tool you could use. Actually, I have a lead magnet, so you can use that. And just really focusing intensely on your burn. Looking at your cash flow, looking at your runway, looking at your burn rate, looking at your burn multiple. And the thing is, they're not set in stone. Like your runway, your burn, and your burn multiple are they're kind of like a moving feast, I think, because if you're on that journey and you're starting to build and you're trying to get traction, then you're going to be constantly changing either your marketing strategy, or you're going to be changing your product development, or you're going to be doing pivots. And every time you do all these things, it impacts your cash flow profile.
Yeah.
So you need to be aware of, okay, if I move in that direction or I move in this direction, what's the impact on my expenditure, or what's the impact on my customers?
Yeah. One thing I wanted to ask you is, when is the right time in that journey for founders to start looking at accrual accounting and switching from pure cash flow?
Yeah, I mean, I've seen some posts saying that you can do SaaS on cash all the time, but to me, that's I'm not a believer in that. I'm always a believer in always going accrual. I mean, I think if you start at the very beginning with that discipline of accrual, it teaches you a lot about how to measure it's a more accurate way of measuring your economic performance. That's what it is at the end. That's what accounting is at the end of the day. Accounting at the end of the day is a quantitative expression of your business's economic performance. That's what it is. And accrual is the closest thing accounting has to accurately measuring your economic performance. So I think the earlier the better.
Yeah, great way to put it, and great answer. I want to fire a couple of quick fire questions at you. One we've kind of already answered, but maybe in a bit of a rambling kind of way. So I want to give you an opportunity to sort of sum up this question. How early should founders start forecasting? And I'm going to just add to that both expense and revenue forecasting. And how detailed does it really need to be? Can you give us a crisp answer on that one for Ash?
Okay. So you should start doing a cash flow forecast from day one, because your burn and your runway are from a finance perspective is the most essential aspect of your business. So that's number one. And that will be on a cash flow basis, looking at your revenues, your expenses, and all your various grants and other forms of income coming in the door. So that should be from as early as possible, and it should be very short. It should only be, like I said, 3 months, because your business will be constantly in flux. You'll be constantly changing. And to forecast beyond that is really doesn't have much value.
Makes sense. Yeah, great.
Anything else?
Let's go to the next question, which is from May in Perth. What finance decisions should founders delay until after product market fit? This is a fascinating question.
That's an interesting question. What finance decision should they delay? Anything expensive. Delay any expensive decision until after product market fit. I think it's the best answer I can give. So don't hire that VP of sales before product market fit.
Wow, that's a great answer. That is such a good answer.
Don't hire, some heavy duty ex-Canva executive to join your company before product market fit.
Oh, wow.
It's going to be really expensive.
I've made that mistake. Not with Canva, but in Silicon Valley with another high-profile executive. That is such a good answer. It really is. Last quick fire question is, what's the most common finance mistake you see early founders making?
Investing too much into the product. And I know that's kind of a strange answer, but the reason why I say that is, and it's been said again and again and again, we really focus on perfection. We really focus on getting everything perfect before we roll it out the door. So what does that mean? That means you're investing a lot of your time in developing your product before testing it. I mean, there's a reason why, that's the reason why you have an MVP, the minimum viable product. Yeah. Roll that out the door as fast as possible to test it before you start investing too much into the product. So that's number one mistake I've seen again and again.
Great answer. Another great answer. So valuable. I wish we had more time. This has been such a valuable conversation, Cornell. I've really enjoyed your wisdom and experience that you brought to the table on finance. And for anyone that's found this conversation valuable, if you want to follow that conversation with Cornell, you can do that on his LinkedIn, and you can find him there on that left-hand QR code. And if you want to check out Adeptx, his website is there on the right. Cornell works hands-on with SaaS founders to build financial clarity and decision-making systems. and I'm sure he'd love to have a chat. And as you say, your ideal customer is a little bit later stage than we typically work with. So you're in the 3 to 5 million ARR sort of stage. That's really your ideal customer, isn't it?
Yeah, it is. But I'm happy to chat to founders anyway, because I'm always fascinated by what people are building. There's been, I've seen some really amazing innovations, and they're still early stage, so I can't really help them too much. But I'm just fascinated by the products that they're developing. It just helps me understand.
Yeah, that's great. You're obviously passionate about what you do. You're passionate about founders, and you know your stuff. I just love talking to service providers that are really dedicated. And I think this is one of the things that frustrates me about the startup ecosystem is the amount of professional services businesses, accountants, lawyers, marketing agencies that help founders when they're not really experts in the startup ecosystem. And they don't really understand startups. They've got plenty of customers that are startups, but that doesn't make you an expert at startups and what startups need. And it's clear that you really know your stuff when it comes to startups. So if I was a founder, I would definitely be taking up your offer there to have a chat. Can I ask you one last question? That is, if you're a founder, an early stage founder, pre-product market fit or $1 million or less in ARR, what's the one thing that you would recommend a founder to do this week for their business that might help them?
Have a look at the risks they're taking from a quantitative viewpoint. Have a look at saying, okay, because I think with founders, they have a million ideas in their head and they're constantly changing. They've got a million directions they can go to. So I'd say one thing you could do is to sit down and really focus and say to yourself, okay, for 2026, or maybe for the next quarter, what are the top 3 things I'm going to take a risk on? Not the 10 or 20 or 30, just 3. Just focus on 3.
What are the top 3 risks for the next quarter? That's a great takeaway. Cornell, thank you so much for joining us. It's been hugely insightful. I've learned a lot. Hopefully the founders have learned a lot as well. You've given some immense clarity, which is what we try and be about at LeapShip, is to help founders with clarity, because as you say, they're working on a million things, and the more clarity we can provide, the more they can figure out what are the most important things to work on. So thanks so much. We really appreciate it.
Pleasure, Kirk. It was a lot of fun. You've asked some really good questions. I really enjoyed them.
Brilliant. So good. All right, we'll see you soon. And let's move on quickly to do a quick plug for our next guest. Our next guest is Michelle Hill. She is an AI execution specialist at the Discover Your Edge. And we're working with a lot of AI founders. And I really enjoy spending time with people like Michelle, who are working directly with customers to implement AI. And that's very different from a class of founders we work with, which are much more product focused and wanting to build and launch a product, and maybe don't have the experience and visibility into what it means to actually get AI deployed into a customer and get it adopted and get it sticky. And so I just love talking to people like Michelle, who can help founders get that insight into the reality of deploying a product, because at the end of the day, if you want a successful product business, you need customers to love your product and deploy it and keep using it and keep subscribing year after year. So don't miss that one. It's on the 20th of February. Of course, if you're a founder looking for more clarity, the kind of clarity that we talked about today with Cornell across your entire startup, whether you're pre-product or whether you're post-product and looking for better traction, if you've got challenges and you're just frustrated with your progress, you're capable, you've got a great idea, but you just need the right kind of support, come and chat to us. We would love to have a chat to you. We have a fabulous session called a Startup Builder. In 3 hours, we will give you more clarity about what you need to do and give you that 6-month plan for exactly how you should spend your time and your money, very tailored to your particular circumstance and the business that you're trying to build. If you want to book one of those strategy sessions, there's a link there. If you're not sure whether that's the right thing for you yet, and perhaps you just want to have a chat, like Cornell said, I love having a chat to founders. I love learning about what you want to build and the change that you want to make in the world. That second link is a 30-minute link, calendar link to just book a chat with me. I'd love to chat to you and perhaps share any wisdom and insight and point you in the right direction. So that's our show for today. Thanks so much for joining, those people that joined us live and online, and we will see you next time.